Welcome into another daily editorial here on the KE Report, chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, you brought up something to me off mic that I find very, very interesting, and this is comparing the longer-term charts for the gold stocks to a couple historical events, and that is the S&P 500 chart after the Great Depression, housing stocks after that collapse, and Thailand in the late 90s. All of these, you're seeing similarities in terms of the correction that gold stocks have just gone through and this relatively slow and choppy recovery that we're in the middle of right now. Can you break down the similarities as to why this caught your attention and why you think it's important, please?
Sure, Corey. Well, in the last several months, well, even going back to the end of last year when we had this big correction in the miners. I was looking at historical comparisons, and the one that always came to mind was the housing and banks bust. Of course, after 2008, I should say during 2008, and then they bottomed in 2009. And what caught my eye is those markets, they had a strong move off the bottom, but then they consolidated and corrected pretty substantially for about a year and a half. And that was essentially through 2010 and then into 2011. And they started to move up after we had that secondary bottom in the major markets, I think in the summer or fall of 2011. And so looking at those, they really caught my eye because the gold miners have been consolidating for a while. And I thought that's interesting because gold stocks had a really bad bear market, and they're starting to consolidate. And I picked this up again over the last week, and I started looking for other comparisons that made sense. And there's two other ones that I found. And one of those is the Great Depression in that bear market for the S&P 500 from 1929 to 1932. So it was about a 3-year bear market. The decline, I don't have the figures in front of me, but it was about 87 or 88%. And then the stock market had a sharp initial rise, but then it corrected and consolidated for about a year and a half before it made its next leg up. And these corrections and consolidations, again, I don't have the figures in front of me, but gold stocks have declined about 40%. And I think the S&P declined during that time around 35, maybe 40%. And in addition to that, another one that I thought about that I wanted to check, I thought, oh, well, Thailand, that was a pretty famous bust in the mid to late 90s. And sure enough, Thailand declined about 88%, and its bear market was 4.5 years. And it had an initial rise that was very comparable to the initial rise in the gold stocks. And then I believe it corrected about 50%. And its correction in terms of price lasted a little bit less than a year and a half. Then it had a good rebound. Then it came back and retraced much of that rebound and made a higher low. And that was less than 2.5 years into it. And that's when that market really took off. Now, if we look at those two examples along with housing, because the bear market in housing stocks was 3+ years. It was 2005 to 2009. And again, all these markets had over an 80% decline. They had an initial rebound of that lasted about 6 months to a year, an initial rebound of roughly 150%. And then they consolidated and corrected a good amount in terms of price. I mean, we're talking about at least 30%, probably an average of around 40%. And that lasted a year and a half or even longer. And then after that point, the markets then made an impulsive move higher and really kind of resumed the resumed the bull market that began from the initial low. I mean, if you're looking in terms of Elliott wave analysis, we're basically talking about this long correction and consolidation is a really long, big wave 2. And wave 3, of course, is the best wave. And so that's what this correction and consolidation would lead to. But I find it fascinating, and I find it really positive for gold stocks because looking at all these historical examples, it tells me that probably at some point in 2018 we're going to see this next leg higher in the gold stocks. I mean, obviously this history doesn't tell us anything about fundamentals. It doesn't tell us an exact point in time where gold stocks might begin to shoot higher and begin that next leg up and begin that third wave. But I mean, it does give us a general guide as far as time and somewhat price that gold stocks at some point in 2018 should really begin that next leg higher and have a major move higher where they run to the 2016 highs and then eventually break out. And as far as when could that next move really begin? I mean, obviously nobody knows, but just from looking at things closely, I'm kind of guessing it's probably around the middle of the year. Maybe it could be sometime in the summer. So that's what I'm looking at. And it also makes a lot of sense because if you just look at like a 5-year chart of gold and the gold stocks, you can see that there's these huge bases and you have that resistance around the 2016 highs. And so if precious metals can break above that level, the 2016 highs, they're going to have a very strong move higher. So tying all these things together, I mean, I'm not bullish right now in the sector, but I do think we have a chance to make a meaningful low at some point next year. And after that, things could be really, really bullish.
Okay, so again, looking into next year is the time when we could get finally that move up that takes out that 2016 high, and again, a lot of that almost open air above that level. But as you were kind of saying, it sounds like we also could expect maybe a bit of a pop, let's say early on in the year, that maybe doesn't quite take us to over that high, almost another one of these bounces that gets people optimistic, and we see a bit of a pullback before that actual move higher and breakout. Is that to be expected as well, possibly?
I mean, it depends how low we go first. I mean, if we see a real break lower here, where let's say GDX in the next month or two would break below 21, that I think would set up a really good rebound early in the year. But if we kind of just go sideways and maybe just we don't go down that much over the next month or two, that would not lead me to think that a big rebound is coming early in the year. So it really depends. It depends on how the market performs over the next month or two. I mean, if it can get really oversold, that would be a good thing. Of course, it's not a good thing in the short term because that implies lower prices. So it's really a function of that. I mean, the lower we go over the next couple months, the higher the rebound we would get early in the year. And I mean, it remains to be seen. I mean, if that happens, we get a rebound at the beginning of the year, maybe we get a higher low around the middle of the year, and that's when things really take off. But for me, I'm just, we talked about it beforehand. I mean, we just have to be really patient here. And, the market is not any threat. It's not threatening any breakout here in the next month or two. We just have to be really patient, buy value. And if we see the gold stocks break down and get really oversold, that's something you really want to jump on, not something you want to be scared away from. So, I mean, hopefully there's not too much damage in the short term, but hopefully sooner rather than later, we see the market get really oversold and hated again. And, because that would be the point where we could buy in and that would produce a really good rally.
Okay. Interesting comments. And again, regarding potentially some sort of a breakdown, which, as you're saying, would actually end up being positive and even better for the markets in the longer term. What would a breakdown that you would like to see look like? Would it be a week of just daily drops of a couple percent and almost a straight down decline? Or would it be, again, almost this kind of grind lower throughout maybe the rest of this year?
I mean, it could be either or. I think I'm looking for, I guess, more of a price decline. And so as far as your answer, it would be more in terms of price than time. And so GDX is trading just below 23 right now. I'd like to see it test the December low, or even if we get really oversold and it goes a little bit below the December low. I mean, what we're talking about here, Corey, is really a false breakdown or a bear trap where the market looks like it's having a big breakdown, but then it suddenly reverses. And so I think I think this weakness could lead to something like that. Certainly if GDX were to lose $21. So I guess that support for much of last year around 21, it bounced from there 3 times. that's something I would like to see, is a move below 21, because that would you'd get the weak hands would probably sell out, technical traders would turn bearish, and then the miners would come. They'd probably test the December low, and so that's what I would want to see, I guess. To be very specific, a move below 21 and then a test of that December 2016 low, because I mean, there's just really, really strong support around that area, and that's what I would want to see.
Okay. Well, hey, Jordan, some interesting comments and some interesting similarities that you're pointing out in, well, a wide range of markets, but history does repeat itself, and if you're seeing the same technical patterns, then that is encouraging, but again, almost on the same vein as what Doc and I were talking about just a little bit earlier. It's going to take some time, and we have to look to next year. We just don't exactly know when next year, but it seems to be the middle to later part of the year. Again, though, let's see where potentially this correction that we could be in for takes us to. You shared some good levels and gives us something to follow. Thanks for your time today, Jordan, and have a great rest of your day.